Most people will never build real wealth from investing. Not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the ProfitByFriday.com podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Now, let us get into it. How do you actually analyze small and mid-cap stocks? Not large caps, not the S&P 500 names everyone already knows. The smaller companies, the ones that do not have 17 analysts covering them, the ones where the information is harder to find and the stakes feel higher because the volatility is real. It is a great question, and the honest answer is that analyzing small and mid-cap stocks requires a slightly different mindset than analyzing large caps. Not a different framework, a different application of the same framework. At Profit by Friday, we use the clear framework for every stock we evaluate, regardless of size. Catalyst, leadership, earnings, accumulation, risk, and reward. The 5 pillars apply whether you are looking at a $500 million company or a $50 billion company. But here is what changes when you go smaller. The information gap is wider. A large cap company has dozens of analysts publishing research every quarter. A mid cap might have 3 or 4. A small cap might have 1 or none. That means you are doing more primary research yourself, reading the actual earnings transcripts, going through the 10K, listening to the conference call, rather than reading a summary of it. That information gap is exactly where the opportunity lives. The reason small and mid-cap stocks can outperform over long periods is precisely because they are underfollowed. When fewer people are looking, mispricing happens more often. Your job is to find the mispricing before the crowd does. The catalyst pillar becomes more important at smaller sizes. A large company like Microsoft has multiple growth drivers running simultaneously. A small or mid-cap company often has one primary catalyst driving the current move. You need to identify it clearly. Is it a new contract, a product launch, a regulatory approval, a new market entry? If you cannot name the specific catalyst driving this business right now, you do not have enough conviction to size a position. The leadership pillar also carries more weight. In a smaller company, the founder or CEO has an outsized impact on outcomes. A great operator in a small company can generate returns that a mediocre operator in a large company never will. We look very carefully at insider ownership at smaller sizes. A CEO who owns 10% or more of the company is aligned with shareholders in a way that a hired executive running a mega cap rarely is. The earnings pillar at smaller sizes requires extra scrutiny. Small and mid-cap companies are more vulnerable to earnings volatility. A single bad quarter can destroy a year of price appreciation. What we look for is not just growth, but consistency. Is the company hitting or beating its own guidance? Is revenue growth translating into margin expansion? Is free cash flow positive and growing? One specific thing we watch at smaller sizes is the deceleration flag. If a company has been growing earnings at 40% and the most recent quarter shows 25%, that deceleration matters more at a small cap than it does at a large cap. Small caps are often priced on momentum. When the momentum in the earnings line changes, the multiple compresses fast. The accumulation pillar is where small and mid-cap analysis gets genuinely interesting. Institutional ownership at smaller companies is a powerful signal. When a major fund starts building a position in a small or mid-cap, they cannot buy everything at once. They have to accumulate over weeks or months without moving the price against themselves. That accumulation shows up in the volume data before it shows up in the ownership disclosures. We use Wyckoff volume analysis to read this signal. Up weeks on high volume relative to down weeks on lower volume is the footprint of institutional accumulation. You are watching the smart money load the truck quietly before the announcement that sends the stock higher. The risk and reward pillar at smaller sizes requires tighter position management. Volatility is higher, spreads can be wider, liquidity events happen. The measured move targets we use in the clear framework account for this by requiring a minimum 2-to-1 risk-reward ratio before we enter any position. At smaller sizes, we often require 3-to-1 or better because the downside scenarios are more severe. Here is the summary of how small and mid-cap analysis differs from large cap in practical terms. You do more primary research because the secondary research is thinner. You weight the catalyst more heavily because smaller companies live or die on execution of a specific initiative. You watch insider ownership and accumulation more carefully because the alignment signals matter more. You apply tighter risk management because the volatility is real and unforgiving. The clear framework does not change. Your attention inside each pillar shifts. The underfollowed space is where the best opportunities in the market consistently emerge. The work is harder. The information is thinner. The rewards for doing it properly are proportionally greater. That is why we spend our time in small and mid-cap territory at Profit by Friday. And it starts with the same 5 questions every single time. The clear framework: catalyst, leadership, earnings, accumulation, risk, and reward. Amateurs avoid what they do not understand. Investors go where the crowd is not looking. Visit profitbyfriday.com today. Subscribe free to the Friday Flash, where you will receive one stock fully evaluated through the clear framework every Friday, so that you know everything about the company before you decide to invest. No noise, no hype, just the analysis that matters. We trade for cash flow. We invest boring to build legacy. See you in the next episode. Bye for now.